Welcome, everyone. Thank you so much for joining me for today's explainer. We are going to jump right in and unpack the financial resilience and the absolutely rock-solid credit rating of a true regional jewelry titan. We're talking about Thangmayil Jewellery Limited, or TMJL. You know, if you've ever wondered exactly how a regional player doesn't just survive, but actively thrives in a sector that's famous for wild price swings and absolutely cutthroat competition, well, you are definitely in the right place.
Here's a quick roadmap for what we'll be covering today. First, the Golden Goliath. Second, strengths driving the rating. Third, risks in the retail model. Fourth, mitigating the golden risks. And finally, we'll wrap up with the final credit verdict.
Okay, part one, the Golden Goliath. Let's set the stage and look at just how massive this regional player has actually become. Let's just take a second to process this staggering number. 8,500 crores. That is Thangmayil's operating income for the financial year 2025 to 2026. And what makes this figure truly mind-blowing is that it represents a 73% year-over-year growth. Now, you might be thinking, well, obviously gold prices just went up. Actually, scratch that. It's not just price inflation. They managed to drive a super healthy volume growth of around 12% as well. Basically, they're moving way more gold to way more people at much higher values. And this really illustrates how they're moving all that volume. Look at that footprint. 66 showrooms primarily spread across Tier 1, 2, and 3 locations in Tamil Nadu alone. They are serving a massive, deeply loyal base of over 45 lakh customers. So they aren't just opening random stores. They're literally embedding themselves into the fabric of the community. They have this incredibly dominant position in the Madurai market and have built up powerful brand recall across multiple districts. Moving on to part two, strengths driving the rating. Let's look at the positive side of our credit scale and examine the fundamental strengths powering their top-tier rating. To really grasp their strength, we have to understand how the whole market is shifting right now. There's this massive change happening in consumer behavior. Historically, the jewelry market was mostly dominated by unorganized local players and impulsive purchases. But today, faced with economic uncertainty and sky-high gold prices, consumers are getting cautious. They're migrating straight toward organized retail enterprises like Thangmayil. Why? Because they want purity assurance, they want transparent pricing, and they want structured saving schemes. Thangmayil is perfectly positioned to capture this massive flight to quality. And that revenue growth, it's translating directly to their bottom line. Notice this jump in the operating profit margin. They went from 4.4% in FY 2025 up to a very robust 6.6% in FY 2026. That is definitely no accident. This comes directly from scale-led efficiencies and their highly successful strategic expansion into the really mature urban market of Chennai. Basically, they scaled up and their margins actually got better. So if we synthesize all these strengths together, the picture is pretty clear. Thangmayil exhibits really strong organic growth fueled by a fiercely loyal customer base and that industry-wide shift toward organized retail. Couple all of that with scale-led efficiencies, and you've got a formidable market profile that's generating solid, super reliable cash flows. That is a very heavy weight on the positive side of our credit scale. Let's pivot to part three, risks in the retail model. Because, let's be real, no business exists in a vacuum, especially not one dealing in precious metals. Let's place the inherent industry risks on the other side of our credit scale. The first massive risk is something finance folks like to call working capital intensity. Let's break that financial jargon down a bit. When you walk into a jewelry showroom, you expect to see a huge variety of beautiful designs, right? Well, to provide that kind of experiential shopping, Thangmayil has to hold about 3 to 4 months of inventory across its 66 stores. And gold is wildly expensive. Holding that much gold locks up a massive amount of cash, which means the company has to borrow heavily just to keep the shelves stocked. Next up, notice their revenue concentration. Roughly 90% of their top-line revenue comes from a single source, gold jewelry. So the absolute crucial point here is that their entire business performance is highly, highly sensitive to the wildly fluctuating, globally controlled price of a single commodity. If global gold prices collapse, or if extreme price spikes suddenly crush consumer demand, their primary revenue stream is going to take a direct hit. And we got to add one more heavyweight to the risk scale. Despite their absolute dominance, 100% of their showrooms are geographically concentrated in just one single state, Tamil Nadu. Now, while this definitely gives them incredible local brand equity, it also means they are highly exposed to regional economic shifts, localized extreme weather events, or even state-specific regulatory changes.
All right, on to part 4, mitigating the golden risks. We've seen the substantial risks they face. Now let's look at how Thangmayil's management actively defends the castle. Their absolute primary shield is a strategy called inventory hedging. Remember, because they hold absolute mountains of gold inventory, a sudden drop in gold prices could literally wipe out their profits overnight. To prevent this, they use financial tools like gold metal loans and derivatives. Think of it like a massive insurance policy. It protects their profit margins from global bullion chaos, ensuring they actually make money on the retail markup and the craftsmanship, rather than just gambling on the daily price of gold. Let's rapidly walk through how this builds into a literal fortress of financial prudence. Look at these defensive maneuvers. In FY26, roughly 95% of their inventory was fully hedged. That is incredibly disciplined. Next, they use an asset-less expansion model, meaning they lease their showrooms instead of buying the real estate, which keeps their capital free. Astoundingly, they report positive EBITDA, meaning healthy operating profits before taxes and depreciation, across every single one of their 66 outlets. There are literally no deadweight stores draining their resources. And finally, they offset their borrowing needs with strong inflows of customer advances. They're basically getting their customers to help fund their working capital. And finally, part 5, the final credit verdict. We have weighed the inherent risks of the gold retail business against management's highly disciplined mitigation strategies. So, it is time for the final verdict. And here is the official verdict from the rating agency ICRA. Rating reaffirmed at A+ with a stable outlook. This tells us that the credit scale balances perfectly in favor of financial stability. Despite the volatile global environment and high interest rates, the rating agency has looked deep into Thangmayil's books and confirmed that their market position and financial risk profile are highly, highly comfortable. If you want the hard, undeniable proof behind that A+ rating, well, the metrics pretty much speak for themselves. Operating income absolutely skyrocketed from about 3,800 crores to over 8,500 crores in just 2 years. Profit after tax nearly tripled. But the absolute most important metric for a credit rating is total debt to OPBDITA, which is essentially their debt compared to their core operating earnings. Despite their massive expansion, they aggressively deleveraged, dropping this ratio from 3.7 times all the way down to an incredibly safe 1.6 times.
I really want to highlight this quote directly from their disclosures because I think it captures the entire essence of this explainer. TMJL's planned versus achieved performance in FY 2025-26 underscores its execution discipline, reinforcing confidence in its operational reliability. See, this credit rating isn't just a lucky byproduct of good market conditions or high gold prices. It is the direct result of strict, highly disciplined, conservative financial management in the face of extreme global volatility. Which leaves us with this final thought to ponder. As consumer preferences continue to shift towards structured, transparent retail, and as global gold prices remain completely unpredictable, can hyper-focused, incredibly disciplined regional fortresses like Thangmayil continue to outshine the sprawling national giants? Well, based on their credit profile, they certainly have the financial armor to try. Thank you so much for joining me on today's Explainer. Keep learning, keep questioning, and I will see you next time.